Okay, tonight's lecture is on cycles. There are some technicians that focus almost solely on cycles. They believe that you can analyze the stock market or an individual stock or other markets mainly by looking at time cycles. I consider it one input, and I personally certainly wouldn't want to try to operate on some rigid cycle. However, there are cycles in the market, there are cycles in nature. We can't ignore them. They exist. If they exist in nature, there's no reason why they shouldn't exist in the market. There's a lunar cycle. It takes about 30 days. We have a seasonal cycle. Every summer it gets hot. Every winter it gets cold, right? There are times to plant crops and times to harvest them. So obviously those kind of macro elements are going to affect people and the whole economy. Jonathan is with Yelton Fiscal. It's an advisory service. They specialize in cycles. They have, well, Jonathan will tell you, they have cyclical data on stocks and commodities and world markets. And this is why we follow it.
All right, let's get going. The cycle model that we have shown on the board is not an accurate depiction or a true depiction of the way markets work. It's true about 15% of the time. And what I mean by that is that capitalism, generally speaking, is not a zero-sum game. In other words, it's not a quadratic experience, equal amounts up and equal time down. You'll note in the red at the bottom, the model is meant to indicate trend in cyclic time frame rhythms and not absolute levels of magnitude. We'll come into some of the principles of cycles as we move along that will help us to determine what the odds are for for more or for less magnitude when we look at some of the principles that are important. Right now, what I'm trying to show you is that there are cycles that operate within cycles. There's a long-term trend there, which we depict as the 4.5 year cycle. It's called the kitchen wave in cycles parlance, after the man who did some work in Harvard in the 30s and was working with another economist by the name of Schumpeter. And it's basically a 4.5 year rhythm. Within that, there are larger intermediate rhythms depicted here, and then there are tiny short-term rhythms. We use daily data to get the short-term rhythms, and they're quite noisy. We don't do anything in our shop under 1 day, but there are certainly people who do intraday work of all sorts. What do we have next, Phil? Okay, some of the principles of cycles that you'll need to become familiar with, not only because it'll help you to understand duration and forecasting, but also because I think you'll be tested on it, is amplitude of a wave. What we mean by amplitude is the distance from the trough to the peak, or here to here. So think of the larger the amplitude, the bigger the wave. Think of going to the beach. They're the big rollers that come in that are quite large and rather intimidating. There are smaller wavelets on top of that, and there are even smaller things that are just the spume and the foam and the spray that comes off the top, depending on how the wind gets it. But the amplitude of the wave is basically the distance from the peak to the trough, and it says a lot about how dominant that wave is and how important it may be. There's also periodicity, or the period of the wave. The bigger the wave, the longer the time it takes to go past. And thinking of the beach again, the period is a measurement not of the vertical distance, that's the amplitude, but of the horizontal distance between trough to trough. The bigger that thing is, the more important it is. You think of my first chart that we had on there. The big one is 4.5 years. The smaller one is trough to trough, maybe something on the order of 16 to 20 weeks, a little less than half of a year.
We always measure cycles from trough to trough, right?
Cycles are far more regular if measured trough to trough. They can be quite irregular if measured peak to peak. And phase difference is two items cycling, not quite in harmony, but one leads the other. In the good old days, financials would lead other parts of the stock market up, and one would be a leader, one would come in later, and then there'd be true laggards. We'll look at some of that a bit later. But the terminology that we're just showing you initially to get started here is the phase difference, which is a calculation of time. On the horizontal X line, X-axis, you have time, and then here we have price on the vertical. All right, so what do we do with these different waves? Some have a long periodicity and quite a high amplitude. Others seem to be smaller, as we saw in our very first chart. Well, we can sum them, and there's a principle known as summed cyclicality. It basically says that we can make some forecasts about the direction and the amplitude of the total movement by recognizing the different oscillations that are prevailing in the marketplace and summing them. So this is dominant. A is, you can see that there. The A wave is dominant because it's the bigger wave, trough to trough and peak to trough. And then there's something that's smaller than that. It looks like it's harmonically related to it by 2, and which we'll talk about harmonicity in a moment. And so what you can see is that when you're in the down wave here and you get a countervailing recovery, it tends to decelerate. In toto, it tends to decelerate the entire move and put the brakes on briefly. And then when they all go together, it accelerates. And this is very relevant to our current market experience, where there are a lot of rhythms that are all operating together in one direction and very little counter-cyclicality in the market, although it's beginning to become more fractured. And we might have time to talk about some of the current marketplace.
Does everybody understand what he said? The reason that we have a weak move up here is because the short-term cycle is working against the longer-term cycle. Right? Sometimes when they're in gear, you're going to get on the upside. You're going to get a big peak, a high peak. When they're in gear on the downside, you get the deepest trough. So.
And the same principle operates in the other direction, of course. When everything's going together, you get these very accelerated movements. If you understand that in a trading platform, you're making a lot of money, but one goes against the other. There's a pause and a hesitancy to the move, and it's a braking influence. So that's summation.
What I said very much at the beginning of this course when we were talking about trends, you always need to know what the next longer trend is doing. If you're trading a stock with a four-week horizon, you sure as heck want to know what that 6-month horizon looks like. Because if they're both in the same direction, you got a heck of a lot better chance of making money or more money, right?
All right, this one is lacking harmonicity. Basically, the rhythm of this B wave, this smaller wave, does not appear to be mathematically related in a particular way to this larger wave.
Harmonious waves will be an even increment of one another, or in the case of a shorter one, an even fraction, 2 to 1 or 1 to 2, right?
And these are lacking synchronicity. You can see that one is virtually the mirror image of the other one. This is peaking when this is troughing. This is troughing when this is peaking. These two items, whatever they may be, bank stocks and golds or something like that, they're the complete opposite of the investment spectrum. They're contra to each other, and they're not at all synchronized. Here we have something that is both synchronized. They're going down together and they're going up together, and they're harmonic in the sense that B is roughly 2 of A. And that's the even divisor that Phil was just mentioning. All right, let's step away.
Okay.
Did you want to say something about that one?
No, I just want to make sure we didn't miss one.
All right, well, those are all sort of academic cycles and some of the principles of them, amplitude and harmonicity and period and so on. Let's look at real cycles. let's look at how they appear in the real world. We're looking at, I mentioned the kitchen wave at the beginning of the discussion. We're looking at real stock market data. It's the Dow using quarterly data. And it's in the immediate post-war environment. And really, again, we're measuring cycles bottom to bottom, and here's the cycle. A to B, B to C, C to D, E to F, so on and so on. So that's a very regular rhythm. I call it the heartbeat of the stock market. It's really almost the heartbeat of capitalism. It's the business cycle that we've all studied in business school, but it's the stock cycle that we're after, because the stock market's a discounting mechanism. It leads the business conditions, and so forth. So it's important to see the regularity of it. Now, of course, these are growing. Let's take a quick look at some of the mathematics that make up these cycles. A to B, we measure it trough to trough, so there you see 51 months. The next one is 53, then 52. D to E is 52. That's a slightly shorter one at 43, and then we return to the more normal periodicity, that period, that trough to trough period of 53 months, which is why we call it the 4.5 year cycle. In cycles parlance, it's known as the kitchen wave, after Joseph Kitchen, who did this work at Harvard studying interest rates, commodities, pig iron prices, and so on back into the 19th century. And he noticed that there's this basic rhythm, this regularity. I call it the simple cadence and heartbeat of the capitalist system. So knowing where you are at any time in terms of that cycle is extremely important in terms of understanding the risk, value if you want, value at market troughs, and excessive at market peaks. What's very interesting about this also is that there's a larger wave that's implicit in this. Let's
ask them why. How do we know there's a larger wave at work? If we're looking at this, how do we know that there must be a larger wave at work? What's happening here? These cycles are at successively higher lows, right? That must mean there is a longer cycle driving it. Right?
So, as a technician, you're going to understand that trend rate of growth. You can apply your see-through ruler to it. You can connect the lows, connect the highs. You have higher lows, you have higher highs. You have growth. You have growth to the share prices as depicted by the Dow Jones Industrial Average. And then something changes. Suddenly you don't have growth. Where A and B, you had a 43-month bull and a 9-month bear. And in cycle C, you had a 34-month bull and a 17-month bear. The next one was a 43-month bull and a 9-month bear. In good times, when you have that kind of growth, we call that secular growth. Bulls are very generous, and bears are rather benign. They're not very damaging. You could be the worst fund manager and do all your investing ticking at tops, and you probably would keep your job, because after you've gone through the contraction, you're back to new highs before a year is even out. So, within the rhythm that I'm depicting here, there's a larger rhythm behind that canvas, which we call the secular trend. And the secular trend is made up of several cycles. It is driven by a number of market forces, which we'll see in a moment. And the other principle here is when it's spent, they tend to last for about 18 and a half years on average. We'll talk about some of the reasons for that. And when it's spent, it starts to go the other way. And when it goes the other way, as it did in E to F, you start to make lower lows and lower highs. In other words, you have a basic contraction. Either corporate earnings are faltering, what you pay for those earnings is declining, so that's the multiple of the market, but basically share prices are just heading lower. And here we see, for example, we went from a bull market of 44 months and a bear that was only 8 to a bull market that was only 25 months in cycle EF to a bear which I think it says was 10. Is that right?
18.
18. It has to be 43. And then finally, F to G is the one that's most quadratic. Like that very first chart that we had on, that's something that we actually experience in real live markets about 15% of the time, a quadratic experience, where bulls and bears cancel out each other. Here we go slightly lower, and basically you can see that the whole dynamic of the marketplace has shifted. This was all the post-war growth, all the pent-up demand, and so on. And then everything just got overpriced and other factors came into view. I think we're going to study those in some of the slides following.
This shows from the period just before 1950 to 75. This 4-year rhythm continued. We have a low in 74, 78, 82, then a 5-year cycle in 87, then 90, 94, 98, 2002. And a longer one, the last. There's only been 2 cycles that were significantly longer in this whole period.
And actually, if we take it backward, we have data that shows this cycle going back to 1710. So it's practically, it's really just before the first industrial revolution, when in England, when economies were changed from an agrarian feudal land system to a mercantile system, cottage industry, overseas trading, and so on, and that was more the inventory that was built up. It was a complete change in the nature of society. It's really quite fascinating when you study these first and second industrial revolutions, which really began in England and then North America, and then later Western Europe. But that's another whole chapter probably unto itself. But it goes all the way back. And as I say, it really is the heartbeat of the whole mechanism. Other cycles are 9.2. This particular one is giving credit to Edward Dewey, showing data from the early 19th century to the mid-20th century. You can see there's a basic regularity here of 9.2. The first person who really isolated this and who gets proper credit for the 9.5 year cycle is a Frenchman named Juglar. And he, again, was looking at bank credit prices, interest rates, commodities, and so on. And he discerned that there was a larger 9 to 9.5 year, or 9.2 if you like, cycle. You can almost see that that's harmonically related by 2 to the kitchen wave, which is the smaller one here. You see there's a cycle in between these two here, here, here. And so there's a harmonicity sort of between the Dewey and the kitchen. And Dewey was a fascinating character working in the mid-19th century. He really departed from the classical economists, Adam Smith, Ricardo, and others, in that he discerned that the fluctuations in the economic phenomenon are not always owing to the tangible sorts of things, money supply, interest rates, policy, fiscal and monetary, but rather there's a basic instability that's inherent within the capitalist system and isn't always owing to these measurable monetary phenomena. Longer still is the long wave, or Kondratiev's long wave. He again was also studying pig iron prices and something called wholesale prices and something called consumables of southern England, which meant corn prices. Corn to them was the kernel of wheat, not maize as we know corn in North America, since it didn't exist. It didn't exist there, but from times actually going back to Henry VIII and earlier, they were very good records of wheat crops and consumption, and it was a good reflection of economic rhythms of the market. Mr. Kondratiev was a Russian working in the agriculture department of Stalin's Soviet Union, Stalin's Russia, and he basically discerned that there was a long wave in economic life that persisted something like 56 or 57 years, trough to trough. A lot of it's quite fascinating, the study. I would encourage anybody to read any number of books that have been written on the long wave. Statistically, statisticians have a problem with it because the thing is so large that there aren't enough observations, according to a statistician, to confirm its presence. And yet, we know that there is a large buildup and then a large letdown. We'll show some of the work that Schumpeter did in Harvard after a little while. But Kitchen's a very interesting character because he came up with this. He was a quiet man working in the agriculture department. And basically what he concluded was that this rhythm was...
Kitchen.
Kondratiev.
I meant Kondratiev.
The other K man. Kondratiev basically concluded that this was a very natural rhythm to the capitalist process. It underwent long periods of growth where the owners of capital could pass on prices, and then it contracted when competition would come in and it would force prices down and capital would have to be reorganized. That's more what Schumpeter got out of it. But basically, Mr. Kondratiev concluded that within the capitalist system there was a revival. It was automatic. It was self-equilibrating. It would get low and then it would stop and then it would revive itself automatically. It was natural within the capitalist process. And poor Mr. Kondratiev was, when Mr. Stalin heard about that, he said, "I'm sorry, comrade, but you're wrong. Capitalism is flawed. What you've said is against the communist dialectic. There can be no natural revival of capitalism. It's inherently flawed." And so Kondratiev was whisked away and was sent off to the gulags. It was never seen. And interestingly, he was doing his work in the mid to late 20s when he wrote his papers, 1920s, right when capitalism was coming into one of these peaks. It was at its point of greatest exposure to the downside. Stalin had in his grasp the one man who probably best understood the long wave and could have helped him make timely forays against capitalism, and instead he just destroyed him. But that's another long wave, or another wave, a particularly long one, the longest that we'll study in this work. Along comes Schumpeter, trained in the Austrian School of Economics, working at Harvard in the 30s, trying to understand the forces that came together and conspired to really knock capitalism on its uppers, really make us question whether capitalism was the appropriate way to organize society, whether there was any way to build true security and true worth. And he put these three rhythms together. There's Monsieur Juglar, which we mentioned in context of the 9 to 9.5 year cycle, which is this one normalized around the horizontal wave. Here's Mr. Kitchen, who was working with Schumpeter at Harvard at the time of the 30s. And here's the big Kondratiev wave that we looked at the slide before, that big 55, 60 year rhythm of capitalism. And Schumpeter put all these together, and using the principle of summed cyclicality, you see where we're going up, you see there's a little deceleration there. That's because the Kitchen wave, that's the 4.5 year cycle, goes into retreat, and as it revives, it's going up in synchronicity with the Juglar wave. Of course, the Kondratiev wave is up for a couple of decades, and you can see the big growth. This is a bigger deceleration because the Juglar wave is down. I like to think of the Kitchen wave as the business cycle, 4.5 year business cycle. It's an inventory adjustment. The Juglar wave is a cycle of capital expenditure. Business is good. Owners of capital reinvest. They create more plant and equipment until it's gone as far as it can go. And typically when you go into contraction, it takes a minimum of 2 downward Kitchen waves to exhaust that downward slope of the Juglar wave. Schumpeter concluded that when we got to the bottom of the big wave, there was a natural tendency for capitalism to be revived in a disinflationary environment, which is depicted by this decline, which often can turn to an outright deflationary collapse. Competition is intense, and but it's within the nature of capitalism. It's almost a natural force that competition will come together and re-innovate We'll talk about the forces of secular trend in terms of innovation in a little while, and it comes back. Schumpeter called it creative destruction. Out of that destruction of that big sweeping downward move that can conclude often in outright deflation, and it's giving us a lot of thought right today. A lot of competition comes in, and then you can have a revival. Other things.
There are cycles in nature. That's why we're showing this.
We know that there are cycles in nature. We know that the sun rises in the morning and sets in the day. There's a natural quotidian routine, a daily routine of sunrise and decline as we roll around. And there's also, we know about seasonalities in terms of the growth cycle for, say, shall we call it North America, Northern Hemisphere. And there are sunspot activities. There's a lot of very interesting things going on with sunspots right now. There is a basic 22-year sunspot cycle. Half of that is the 11-year, and we're late in terms of sunspot activity. We're about a year behind, I believe it is, in terms of our normal expectation for sunspot activity. Sunspot activity has to do with the amount of radiation. It can change weather patterns dramatically. There are many services. I sit on a committee where there's a climatologist that contributes to it, and they study these things very, very closely. And it goes back way beyond the inconvenient truth and some of these measurements, which are really just looking at data from the Industrial Revolution. These can go back tens of thousands of years. But sunspots are also cyclical. It affects grains. A 1 degree change in temperature can move the growing season 300 miles north or south. And that's big. That affects interest rates, storage, and so on. So they're natural, and it's all part of our little presence in this universe. Idealized Elliott Wave. Phil, you're more of an Elliott man than I am.
Okay, we don't spend much time on Elliott on this course. We could spend an entire course on Elliott, but there are some things that you need to know. All the cycles that we've been looking at so far, what have you noticed? They all have time on this axis, right? Price by time. And Elliott is concerned with form, not with time. So when you're analyzing an Elliott wave, you're looking for a form. The form of the impulse or the motive wave, what do we see there? Well, it's 3 legs up and 2 down. The corrective wave is 2 down and 1 up. So normally this is counted, the motive wave is counted 1, 2, 3, 4, 5, and the corrective wave is categorized as ABC. Why do we need to know this? Well, if you do your work on this, you'll learn some very important information on the chart. Because if we discern that we're in the 3rd wave, there are special characteristics behind the wave. We're not going to get into all of that. We know that the 4th wave will be a temporary affair, and you will make a higher high. So there's not too many other technical tools that will do that. Right here, I know that there's a correction coming after this leg that will be followed by a higher high. So that's one of the advantages of Elliott, if you do the work and if you believe it. And you also know that you get this 5-wave structure in the direction of the main trend, and a 3-wave of correction when you're ultimately going to correct it. So that also becomes useful to me, because once I realize that I've made a peak on wave 5, I know that I'm going to have several steps to correct it. I'm going to distrust this rally, for example, right? Those are the things we have to know about it. That form is more important than magnitudes or time. We'll come back at some other point on that.
More on cycles from a seasonal point of view, agricultural point of view. It fits really with what I was just saying about the slide before, the sun spot one. We know when the harvesting season comes, there's lots of supply, prices adjust accordingly, and there's a fairly natural rhythm. The price level can change, of course, depending on how what the degree of pestilence is, or what the global demand for soybeans might be. But it's also related to seasonality and so on. And this we just know naturally.
Time to grow and a time to harvest, right?
Right.
Prices are going up when the commodity is scarce, or it's winter, or it's not growing. When it starts to be harvested, the supply picks up, prices go down. So, obviously, very logical.
There are also seasonalities in stock market performance. Most of you probably have heard of the January effect or the January phenomenon. There's all kinds of debate as to what causes it. Typically, by the convention of a year ending, pension funds get funded and bonuses are giving out and money gets invested, and there's a surge of capital that comes into the market, and it creates an upward movement. And when you have a strong January, you tend to have it the next month following, which kind of lays off a little bit. The other expression is, one expression is as January goes, so goes the year. You get a strong January, you get a strong year. The other expression is, as goes September, so doesn't the market. And in other words, and also perhaps statistically it's better because you're not actually using one of your 12 observations to complete your thesis. But it's natural to have seasonality. It's not something you should follow blindly. Obviously, in the last couple of years, it hasn't been with us. That's perhaps because the bigger picture is going the other way.
It hasn't been that bad. Slightly
And
off. If you notice this chart, if you look at it carefully, you'll see that, and studies have shown that if you only own stocks for 6 months of the year, from the fall low to the spring high, you earn nearly the entire return. S&P has averaged about 10% per year, and the gain from this low to this high is 9.5%. That little piece of information, and it works almost every year, is very important, because just think about performance on a risk-adjusted basis, earning the return but only being exposed for half the time. Pretty powerful. I just looked back at this because we had a bad January last year. By the way, in 2008, the market got killed. There are only 20 down years since 1940, and 16 of them started with a down January. So when January is down, there's been a tremendous correlation. And why would that be? Well, we know that as Jonathan mentioned, a large amount of new money becomes available to buy stock in January. People that sold for tax purposes at the end of the year throw it back in normally. Pension fund contributions, IRA, 401k contributions become available early in the year. So when the market doesn't go up in January, it means that people are making a very conscious decision not to buy stock. That kind of a decision is not reversed very quickly. That's why the January or the negative Januaries have a very powerful indicator.
All right, back to our market cycle model. You might notice, this was the first one that we looked at, you might notice that it bears some resemblance to the Elliott Wave that we saw a moment ago. And people have often asked us whether this is Elliott Wave, and we say, well, no, we've worked with Elliott Wave, and we found it that we do it a different way. But actually, this market cycle model we developed after reading a book that was written in 1903. And it's written by S.A. Nelson, and what's it called? Stock market speculation? The word speculation meant something different. I've suddenly forgotten what the name of the title. Anyway, it's 1903. ABC's of Stock Speculation. That's what it was called. And it was from the verbal rendering of the movements of the market that Nelson expressed in his book, his 1903 book, that we derived this market model showing cycles within cycles. And And so when people ask us, is this Elliott Wave? Well, we say, no, that's not what we're meaning to show. But we suspect that Elliott read the same book. Again,
Well,
back to
we can just,
back to that one, and this is the 19th century. Prior to it, it's the interrelationship of waves within waves. I think that's the reason why we repeated this. And I think this will become clear if we look at the next slide, which is, again, the influence of secularity. It changes the shape of the cycles. Cyclic bulls are strong and bears are minor. Strong bulls and minor bears, when you have a secular trend connecting the lows the way you would with a straight edge, and then they go the other way. And so here's our secular trend analysis in the 1990s. What creates secular trend is longer-term pressures of inflation or deflation. In 1981, interest rates peaked out. Paul Volcker was at the helm of the Federal Reserve. Prime rate was at 22%. It was choking off business activity. Before today, that was the worst recession in the post-war environment. 30 years later, we're challenging that performance. But long-term forces of inflation or disinflation or deflation determine secular trend. Also, the expansionary forces that are built up around a highly integrated and mutually supporting combination of technologies. What does all that stuff mean? Well, we'll look at some S-curves for important innovation cycles. Perhaps most of us in this room don't tend to think of the automobile as a technology, but believe you me, it is a technology as surely as a spinning wheel was earlier in the first industrial revolution, or a canal was a technology, or a steam engine was a technology, a railroad. A car allowed for the expansion of populations out of city centers like New York and out into the suburbs. It's partly population growth, which is the second point. But think of what an economy is. Think about what it means when we say multiplier effect. And think about what we hear about today all the time about infrastructure investment and recreating the velocity of money, putting people at work doing something. When it occurs naturally, we'll see whether when it occurs as a policy of fiscal, as a matter of fiscal policy, secular trends can take on a very strong expansionary force of their own because the automobile, for example, allowed highways to be built and bridges to be built, and the hotel-motel industry, and something we all take for granted today in the form of fast food restaurants. All of those create jobs. They all have to be built. And they're also all supporting by our third item, which is demographics. Populations are growing. That means more demand. It's always a force for growth. Except today in the automobile industry, we note that sales are lower than they were in 1982. And the population is probably in this country 50 million more than what it was back then. This is what the S-shaped curve looks like. I like to call this an immutable law of nature. We use a 5-phase model to describe the S-curve. There's an introduction, a growth, a maturity, a saturation, and decline. It applies to all of us. I call it immutable law of nature because it applies to everything under the sun.
including the sun.
Including the sun. It applies to us as individuals. We have a birth, a growth, a maturity. We know what saturation and decline means. And it applies to whole civilizations. What was that?
I'm getting pretty close.
And it applies to corporations. Does anybody know the average lifespan of a U.S. corporation? They don't go forever. It's about 32 years, at which point in time, whatever innovation, whatever technology they had is competed away, and either they have to innovate or they have to acquire to keep themselves on the rising slope. But there's only one U.S. corporation in the Dow today that was in it when the index was created, in 1897, 98, right at the end of the 19th century. Did I ask the question? Does anybody know what this? What
You asked it. Nobody said.
GE,
That man.
right? And we could all agree that GE is not the company today that it was when it was created in at the end of the 19th century. Back then, General Electric was an amalgamation of companies that were exploiting the innovation of electricity. New York City was one of the first sites of testing that innovation, and the invention of the incandescent light bulb and so on. Just as General Motors was an amalgamation of several dozens of domestic automobile countries that were all amalgamated together. So they run about 32 years. There's only one in the Dow today that was there at the beginning. And, of course, it really isn't the same company today that it was when it was formed. It's not an electricity company. In fact, up until just recently, it was about 45% of their revenue came from banking functions, GE Capital. So it's natural within the capitalist process to follow an S-shaped phenomenon. It's natural for us in life. And if you go back, and I don't know if what's coming up next, if we go back and we think about those very long-term pictures of the stock market, it really also follows a secular trend. So secular trends cause the cycle to change shape from a bell curve, which was our nominal model, to a linear or an exponential experience. This was our model at the bottom. We've only seen quadratic experiences in the investment realm about 15% of the time. When you're in a secular uptrend, what you really have is this phenomenon over here, the one of growth that we saw on the left-hand side of our data series when we tracked cycles from 1950 forward toward the current period.
We've just gone under two previous bear market lows. We've gone under 02 and 1998 today.
Yeah, we topped a secular trend in the year 2000 in our work, which meant cyclic bears would be more ferocious and more punishing than anything that we had seen in the prior 20 years. Because the secular tide was going out. We think yields will be rising. We've seen a complete change of leadership. I think we'll come to that in some of the slides a little bit later. There are various price motion models for the cycle, depending on the secular trend. There's the quadratic. Some stocks follow a straight line for a while, not very often. I mean, they can't follow it forever. Microsoft followed that model for a while. Albertsons, which is a retail grocer. Gillette followed that model for a while. Bombardier was one of the big heavyweights in Canada for a long time until it broke. When they break, it's pretty tough. This is the combination model where it's growth but also cyclical. We use relative strength and some other series to help us, momentum series to help us identify, and cycle analysis to help us identify those turning points so we can manage funds as it oscillates along. And there's all sorts of things about rotation and so on. Finally, here's a real career winner. It's the exponential. If you get everything going in that, you've really hit it. You really hit it right. So we have four characteristics that basically define market cycles. Their regularity, which we saw in terms of the 4.5 year, or the 9.2 cycle, the very long wave, which is the Kondratiev wave, and so on. Juglar's wave, which was 9.2. Their dominancy, longer-term waves dominate. A 4.5 year cycle is more dominant than a intermediate-term cycle. And how do they skew? Well, when there's an underlying force of secular growth, either because we have a disinflationary force and interest rates are coming down, and those help certain parts of the economy like banks and consumer stocks, and operate to the detriment of other stocks that are not the beneficiaries of disinflation, then certain aspects of the market are skewed one way and certain aspects are skewed the other way. And then finally, when we sum all the active cycles together, we can get a forecast for whether we're likely to go more to the upside or more to the downside by understanding all of the interplay between the dominant cycles and secular trends. Here's an example graphic. Here's our S-curve. We really saw this when we looked at the data for the U.S. stock market. And what we mean by this is here's our 4.5 year cycle operating along, oscillating along. When it's got an underlying trend of disinflation, which we had from 1981 until 2000, bull markets grow longer and bear markets are short. When it all tops out, sometimes we call it an orgy of speculation. There's just a wild sort of Jungian psychology. It's a crowd that operates without a rational mind. We've seen this time and time again over the centuries. In our own contemporary time, we may know today, of course, let's work backwards. Today we know about subprime and excessively easy credit and all the excesses of speculation that engendered. 8 years ago, it was the tech bubble, the internet. It was all of this new paradigm talk about how it wasn't about earnings and it was about capturing market share. The markets tend to go into these frenzies that are really operating without a rational mind. We've seen other moments over the centuries, the Mississippi scheme, where a Scottish gentleman named John Law came to France and basically introduced the first concept of paper money. Initially, it worked very nicely. It got credit flowing. And then the discipline started to go away, and they started to print more and more money. And it created a big bubble top. There was also the East India one. And if we go all the way back, even into the 1670s, there was tulipomania, where people was actually the first, in a sense, the tulipomania was the first futures market, because they were actually trading the tulip that was in the ground, and you couldn't see what you had until you dug it up in spring. And sometimes they might cleave into two, and you had a 2-for-1 split. Only you didn't really split; you just had a 2-for-1. And people would trade away. They would trade away all their tools, give up their daytime jobs, if you like, to get in this. And so, when we get to these saturation moments, they can be the crowd can, to use Jungian's term, it's a crowd that's run amok. It's a crowd that's operating without a rational mind, and it's just a herding instinct until it breaks, and then so it's useful if you can understand and have the objectivity of standing back and seeing what's happening, so that you don't fall prey to it.
Nobody believes they're speculating wildly at the top.
They're all in the bubble.
People believe that tulip bulbs would go up and up and up. They believed it.
And house prices always go up, don't you know? All right, let's look at some other S-shaped phenomenon over the years. Well, here's the S-shaped phenomenon of horse-drawn carriages. We talked about at the top of I'm not sure I did mention, at the top of the S-curve, Adam Smith called it competition coming in to tax away excess profits. Business is really good, it's growing and growing, somebody comes in and tries to do it better. Well, that was Henry Ford. Let's find a mechanical horse. Let's innovate. Remember we talked about technology, innovation, that was part of secular trend. That caused the demise of the horse-drawn vehicle. But the need to transport people, the need to transport goods is ever present. And so we've innovated in different ways, and you can see the S-curve for horse-drawn. The consumption of malt liquors is probably very much in concept with population growth. It's a demographic force. It could also be an economic force. In academic circles, we call that a Pearl-Reed curve, which basically monitors a demographic force of population growth. And then sometimes there are irregularities that occur within the natural growth curve of an item. And there's one that happened. Anybody know what that is for malt liquors? Which would be prohibition. And if we were to invert that, we'd probably get a crime crime spike, or some sort of a fat tail that was relative to that one. SCurves can be applied to the steel industry. This is the full record of steel going back to 1901. Yeah, there it is, 1901. We have all the data. That's basically from the time that Andrew Carnegie sold out to J.P. Morgan and it became U.S. Steel Corporation, and the shares went public. And you can see that over the course of now over 100 years, we've had many S-curves. Within the steel industry, it's really more a force of production process technology, which we'll see here. The crucible method was that which was used by Carnegie and his partner Frick, who's given us a beautiful museum, Frick Museum here on Fifth Avenue. And there was another man, an Englishman by the name of Bessemer, who was trying to compete. He came up with a way to make the same unit of steel for less cost. So isn't that what we all try to do? He had a Bessemer process. I believe he was injecting CO2 or something in it to get the impurities out of it. You got a better product at less cost, and that became dominant. Carnegie's partners begged him to come over and look at this process. Carnegie responded, "Pioneer and don't pay." He didn't want to change, but eventually the industry all went there because this was a better way to produce steel than the crucible way. Then there came the open hearth method, then the oxygen method, electric, and if we were to update it from the 70s, there's another one that's underway in steel, which is mini mills and cold press steel and things like that. So it's constantly within the nature of capitalism that things follow these big S-curves, and they occur over many, many years. As you can see, this one is going for something on the order of 50, 60 years before a new innovation cycle takes over and another way of doing it, which speaks to the reason why some companies, well, no company lasts forever. Some other company will come in and do it a little bit better. We are all pretty taken in with the computer industry. We did S-curve work on computers, starting with IBM and its dominancy. On this curve here, mainframes and so on. That's the basic computer trend. There are also things, biotechnology, desktops, then portables, internet, information technology. They all sort of followed the. I remember our first mainframe. We were drawing charts and sending them around. It was a little bit before my time, but for the company, it was 1973. It was over $1 million. You needed a crane. You had to take these windows out. Well, these are too narrow, but you needed a big crane. You had to have special area. It's all been re-innovated. Now you can put how many gigabytes in a shoebox or in your iPod. It's really unbelievable. But they all follow this. Unfortunately, with all the great innovation that came with internet and the tech boom leading into the peak of 2000, it was all at the very late stages of the S-curve, where everything was pretty well commoditized. So that little bubble of speculation was destroyed, and many of those stocks went to zero, and the NASDAQ went down by 85%. There's the automobile that we talked about earlier. There's the dominant S-curve for the technology of the automobile. All the ancillary businesses that support that technology, you've got to fuel them up. We talk about all the challenges in terms of going green today, whether it's hydrogen or electric or fuel cells or how we do it, but how do we develop the infrastructure to support that underlying technology? Hotel, motel, highway construction. This is the current idea of infrastructure investment, which, by the way, is another cycle called the Kuznets Wave, which Schumpeter did not put into his model. Restaurants, franchising, all this overseas expansion, the suburbs I put in there, and the way of life, and all the building that goes on, schools, homes. And you can see that it's natural. All of these things play in underneath a technology called the simple automobile. And there's all this sort of thing. urban adoption, rise of the Japanese oil industry, the embargoes, and so on. It's really quite interesting to follow a thing from its infancy all the way to its maturity. And now we're down to we don't know quite yet. One, we had two U.S. automobile manufacturers when Mercedes took over Chrysler. Then they spit that out as fast as they could, and now we're looking at possible recombinations or bankruptcies. I mentioned how even for whole civilizations, additional to corporations and innovations and people, we have whole civilizations. This is an S-curve reflecting Spanish trade. Spain was, in a sense, the dominant force 500 years ago because they had the advantage of discovery, and they brought home gold and precious metals and stones and all sorts of things. It gave them a huge leg up. There was lots of competition, piracy, or privateering, which was state-sanctioned piracy, and eventually the civilization expanded to the best it can do. They relied too much on the easy money that was just shipped over in Spanish galleons and didn't have any organic growth. It's changed the nature of their society and so on. So it works even for civilizations. I think my point here is to say that when we think of a stock market, it's really a whole lot more than just an index that somebody created. It's really the sum total of all economic activity. That's what Charles Dow invented the thing for. It was a barometer of economic activity. It wasn't so somebody could create a derivative market for it and trade options and futures on options and so on, or the other way around. But rather, it's an indication of economic activity. So here we're looking at 142 years of price history. We cheated a little bit and brought it back. I think this goes back to 1867. And I say I cheated because I mentioned earlier that Dow created his index in 1897 or 1898. We cheated and we spliced it with something called the Axe-Houghton Index. Again, it's just to get that long-term secular perspective of capitalism. And we can see that the index is really a sum total of everything that's in the economy at any one point in time. Whether it's the dominant steel industry in the late 19th century and early 20th century, or the influence of canals in the 1820s, or the railroads in the 1870s, or technology or automobiles, it's all reflected in the one index, and the index itself goes through an S-curve. We can see, for example, here's that post-war expansion leading into the top. We saw that quarterly data when we looked at the kitchen wave very closely. We broke each line here is a year before we looked at quarterly data. So that was a post-war secular expansion. That was a secular down from 1968 to 1982. That looks like a relatively benign plateau phase where you don't get hurt. But those two strokes there are 2 years, 1973 and 74, and the Dow lost 55% of its value. Nobody came out of university looking for a job on Wall Street, unless you were a masochist. Eventually, rates peaked out and started to come down, along with some fiscal policies about sparking the innovative spirit. Ronald Reagan seems to get a lot of credit for that, which is fine, and that gave us our next wave up. You can see now, since 2000, we've been in a downward sloping curve. Point is, beyond the current forecast, the point really is to show the principle that everything follows an S-curve. Empires and innovations and whole stock markets and economies. And when the curve is down, bear markets are vicious. When the curve is up, some cyclicality teaches us that the bulls run longer and the bulls are very, very short. So sometimes these instabilities are extreme. The 1929 collapse is actually quite similar to the tech collapse that we saw from the March 2000 high all the way down, where technology NASDAQ went down 85%.
Financials are down 80% off the top.
And now we have financials. It's not all doom and gloom. I think we're going to come to some good, happy stuff, and maybe in the next. Do you want to comment?
I want to say it's no coincidence that we see the word generation, sells of generation, buys of generation. Secular trends are generational affairs. They last 20, 25 years. Why? Because if one generation goes through a speculative bust, they're out. They're never coming back. If your grandparents or great-grandparents owned stocks in the 1920s, they did not come back in to buy in the 1930s and 1940s. It was a new generation of investors that didn't have that horrible memory that created the next move. So secular trends are very much generational things, and they last approximately a generation.
It takes a generation to wipe out the fear, and it takes a generation that never felt fear to think that it's just investing is a linear experience and you just always dollar cost average your way to wealth for everyone, which of course by definition is impossible. We're talking about 5 basic rhythms to the market here. Secular junctures, which is annual data, which was the chart that we saw earlier. Within that, there are growth rhythms, for which we use quarterly data. And then the 3 cyclical components, which was that first bell curve that we put up, showing the long term, the intermediate term, and the tiny short term trend. And you work them all together for investment success and observe the growth patterns and the cycles that operate within there.
Market made a low in November of last year and hasn't had a worthwhile, meaningful, or exploitable rally. Why? Because the longer trends are down now. Cyclical is down, the secular is down, and so trying to fight that is futile.
We had one little short term up from late November into early January, which produced about 20%.
Most of that was in a couple of days.
Trough to peak, and it was so fast that you really couldn't exploit it terribly well. All right, let's talk about a little joy. After 25 years of secular disinflation, gold has gone down, from 850 in 1981 to 250 in 1999-2000. And speak about generational biases. A lot of people would say, well, gold is some sort of old relic. Why should I pay any attention to it? Something that my grandfather owned. What do? Spend the weekends in your fallout shelter in your backyard? I even have clients who are very savvy investors who say, why would I want to own gold? It's just a rock. And I like to reply to them, why do you want to own all those worthless pieces of paper for which you pay too much? But it has a place in the investment spectrum. It is a great barometer of inflation. It's also a barometer as a systemic risk hedge and fear and calamity. We've seen the fear, especially in the very near term, in the last couple of weeks, when the stock markets have really been coming down hard and gold has been shooting up. Point is, gold's been in a secular uptrend since 2000. So when techs were blowing off and going down in big bad ways, and now the banking sector, which is basically inversely correlated to gold, is going down in big bad ways, this little guy is going up. And we've actually had 1 cycle, 2 cycles, 3 cycles. The 4th cycle peaked in March of 08 at 1,032 an ounce from 252. So whatever that comes out to, 360, 400% in bullion terms. Some of the stocks were up over 1,200%. There's always something that you can be long, almost always something that you can be long when the general market condition is against you. So that's a real-life example of secular growth and the cycles operating within it. We're still in that trend. I'm writing about it actually today. for our weekly piece that'll go out tomorrow night. There's the intermediate trend. What was the one that was before? That must have been the long-term trend. You don't have to go back.
Yeah.
That was the long-term trend. This is the intermediate term trend. So there was our March high of '08. We had the first down leg, a recovery bounce, a second down leg, and since this chart was developed for this class, we're all the way back up here to, we just touched 1,000, I think, on Thursday, Friday last week. We're near an intermediate top, we think now. We'll come back down into this area and then go again and make new highs. The secular trend is there. The secular growth trend is there, so gold can continue to do big things for whatever reason. Short-term trends are minor. So within the intermediate top of March, we had one short-term down and one recovery bounce, which didn't get very far, and then another down that made a lower low, and then another recovery and another down. So these are more minor rhythms within the intermediate, which is itself a minor rhythm within the long term. And just think about that in terms of this market model, where all three of these, there's three rhythms here operating together, one influenced by another. An intermediate uptrend here against a bear market is hampered, and its expansion is retarded by the presence of the longer term bear. Intermediate uptrend here just runs beautifully. It's running with the tide. It can go a long way. It can be comprised of a number of short-term rhythms. Here's 1, 2, 3, 4, and 5 is not unusual, which is a sort of an Elliott count, whereas here we have only 1, 2 short-term uptrend rhythms because the larger trend forces are operating against. So we can take any item. We did this one in
September 30th.
September. The first up leg in the dollar was peaking. Dollar started to go down. It didn't go down very much because the longer term cycle is still up for the dollar, but that gave space for gold bullion to start that move. And that was about late October at 684, and this G to H move took gold not to a new high, but up to where, as I say, it just touched 1,000 last week. So you could look at different market segments and place them on the bell curve, see how they make sense. Of course, it makes sense. Dollar up, gold and energy down. Dollar down, gold and dollar-denominated assets can have a rebound rally. Any question about that? Okay. All right, this one is really interesting. We just sort of did it on a cyclical basis, the slide before. On a secular basis, as I mentioned, there's always something that can bring joy when something else does not. So if we look back to 1981, which was an inflation peak, where gold was at 850, the back end of the market, which is cyclic resource, precious metals, which are the deep cyclicals, and energy, we're capturing about 40.5% of the total stock market cap. Countries like Canada and Australia are resource economies, lots of basic materials, precious metals. Their economies do well when you have inflationary times, which we had post-war. First emerging inflation, then accelerating inflation. During that time, Canadian dollar went to a premium to the U.S. dollar briefly. And the back end of the market was getting most of the stock market cap. The front end of the market, which is bonds and basic equities and interest-sensitive stocks, were going nowhere. You wouldn't have come out of university in the late 70s, mid to late 70s, as I did, and go to the bond market department. First of all, they wouldn't even interview you because rising interest rates are not good for bonds. And so the basic front-end banks, bonds, etc., were only getting about, we calculated 11.94, shall we call it 12%. Technology didn't even exist. That was 1981, at the beginning of the disinflationary expansion for the stock market. And these little thin lines are meant to show the cycles growing, as we saw in the real data. And it's windy out there. Close the window on us.
I didn't know it was open.
And the big dominant tech players weren't even public then. I mean, Microsoft and Dell didn't even float shares till 1986, so somewhere in here. So when we talked about S-curves, and we talked about how they were natural and how they had a lifespan, they had a birth and a growth and a maturity and a decline phase, well, and then we said the stock market follows the same thing. Here it is in another sense. These components that are beneficiaries of a disinflationary experience rose until they became about 42%. And it's interesting, they had the same dominant weight at the top of their S-curve as these had at the top of theirs 20 years earlier. And so now down go banks, front end of cycle stocks, consumer stocks. At the top, Microsoft was the number one cap stock. Then the tech busted. And then the banking sector got the next bubble. GE became the number one cap stock in the S&P 500. And it all started to decline. And as we saw, gold was bottoming out, and energy was the structural leader of the commodity sector. They were starting to rise again, as we saw over here, 60 plus years ago. And these lines have crossed now. Does anybody know what the number one cap stock is in the S&P? It's Exxon. Thank you, sir. It's it's doing so well in this environment that they're talking about taxing away their excess profits. Its market cap, I think, is about $350 billion. GE is less than half of that. I think GE is maybe around $120 billion now. Forget Citi and the rest of them; they've all dissolved away. So we've just crossed. We're about halfway. Once we get through the severity of this current cyclical contraction, we think that the underlying forces of secular expansion that we've seen operating in terms of the commodities, the energy, the golds especially, will continue, and they still have quite a bit of life of them. A couple of more of these cycles, these thin little lines that are up. This is the 4.5 year cycle. So they've crossed now, and maybe in another 8 plus or minus years, they'll peak out. Here is our commodities model, 1932 to current. Here's the big S-curve. Gold at $20, copper at 4 cents, all the way to the top with copper at $1.30 and gold at $8.40 an ounce. Crude oil at $39. Everyone thought for sure we were all going to go to $100 a barrel. There was an OPEC problem, and the Middle East was shutting us off. But then we disinflated. Interest rates were at 22%. They made their way down. Gold made its way from $8.40 after 4 cycles and recovery bounces down to $2.50. Energy went from $39.40, shall we call it, to $9.35. Price isn't on there anyway. There it is, Brent crude, $9.35. Lots of people thought it just would keep on going, just as they thought energy would keep on going here to 100. They thought it was going to go down to 4.5. I believe Ford Motors corporations, economists were forecasting $4.50 oil. They were just extrapolating the trend of their generation, and they were going to build something I like to call the Ford Valdez, which gets performance metrics that's based on gallons per mile. Now, of course, we know that things like the Hummer are gone. Anyway, we made the bottom. We started a new secular trend, and we cycled along. That first move, we thought we'd see 60 plus or minus in oil when we were at 9.5. Sounds pretty quaint today, but I can tell you that really shocked people. Most people thought we couldn't go to $20 a barrel, let alone 60. We went to 32 at that peak there. We thought it'd be about 35. We did 32, and then the cyclic bear came. And so we went from 32 down to 16. Well, somebody said, well, how can you talk about inflation in commodities? Don't you see you've had a halving in the barrel price of oil? You've gone from 32 to 16. We said, well, that's just the bear cycle. That's just normal to have an especially high beta turn around a secular juncture like that. And you're all good technicians now. So you know what that high means relative, that low means relative to that low. In order to continue that secular downtrend, that bear market had to go to a new low and go to that 450 or so, but go below $9.35, and it didn't. Stopped at 16, and then we expanded, and we expanded again. By the time we got here, others said, "Oh, now, well, of course, now it had to go up because nobody was looking for any oil when it was at 20. I mean, at 9." By the time we got here in March, June of this past year, in 2008, some of them were clambering over each other to say, "I'll see your 60 or your 150, and I'll raise you to 200." And that was right at the top of a cycle. Now oil's come all the way down here, and we think it's only in an intermediate bottom. I don't think we have that data to show you, but the secular trend is still there, despite the economic contraction that we see. Well, okay, so we can look at different stock market bourses around the world. We can place them on the curve. We use a sine wave additional to the bell curve. UADT just means early bull, advancing bull, the dog or the down bear, and the termination of the bear before we cycle around again. When all the stocks are in the same point of cycle, globally, it's a globally synchronized contraction, and it means more magnitude rather than less magnitude to the downside. We call that commonality. And that happens to be a picture of what the market looked like in July last summer. Still in a bear. They've got to all rotate through here and get a revival going, and that's a lot of time from now. It's six months to a year. It's like an aging process. I don't think we really need we don't think we really need to get into it, but think of it as buying low and selling high. When you put items on the bell curve or on the sine wave, you can immediately say who's leading, who's lagging. Well, I want to sell one of these when it's at a top and buy one of these and rotate, so I'm always riding the up cycle. We do the same thing for the short-term trend. All right, this is very interesting. This is a case of commonality. What happens to the global economy, as we saw 2 slides ago, or what happens to the Dow or the S&P or your portfolio when you plot all your stocks and you find that they're all at the top of a cycle? Well, it's a forecast for disaster because everything's all priced up. There's nothing coming down around the bottom. Anytime we find that there's 60% or more in one point of cycle, A plus D being a top skew, then there's increased magnitude potential to the downside, which is what we, of course, got starting in October of 2007. Oil also follows the SCurve phenomenon. We've got oil prices going back to 1867 here. That's basically the full record of petroleum prices since oil became a substitute for whale oil as a lubricant and as a source of household lighting. So practically from the time that the stuff was found bubbling up in the fields of Pennsylvania, oil's gone through secular growth spurts and secular declines. And we've got 1, 2, 3, 4, and now the 5th one started at $9.35 and has already made its new high. So it's got lots of life in it, we think. Another cycle or two, despite the recent contraction. And so that's another example, as we saw in gold. Here's the gold, the full record of gold secular trends. There was the post-war inflation. There was the secular peak in 1981. There's the disinflationary curve coming down. And when we saw the bottom there in around 2000, 2001, we said, you know what? Bull cycles in gold can really run now. And we thought we'd make a new high, which we did in March of 2008. And it's still up. This chart was drawn in, again, I think probably just a year ago or so. Anyway, that secular trend is only youthful. Look at where the smoothing is relative to where it was last time in the 60s, early 70s. It's just in its infancy, and it's already cleared the price level of 1980. Same for silver, which is confirming. You want to look at other aspects in the same industry. Does it confirm and say the same story? Very long-term secular growth is in. It's the only commodity that has not taken out the 1980 inflationary peak. We don't think the secular trend will be over. The secular growth trend for the whole commodity thing is over until silver clears it, and eventually the gold to silver ratio begins to narrow. Finally, business cycle indicators, which we're updating this week. This is a very nice model done by the Cleveland Trust Company in the 30s by Leonard Ayres. We borrowed from it. We start our analysis with interest rates. They follow the same cycle. Then bonds, which are a huge component of the asset allocation model, and then stocks. We break stocks apart in terms of the front end, the back end, and the coincidental part of the stock market cycle. It's part of market rotation. We saw that in our big model when we saw the 42% high of the back end in 1981 and the front end getting almost nothing, and then it all came the other way. So the last thing that you look at in terms of trying to determine where you are at any one time, you follow the dotted line. When interest rates start to rise, the bond markets go south. We draw a straight line from the peak of the bond cycle. Stocks can continue to rise for another 6 to 9 months, usually supported by lagging components of the stock market rotation, which is the back end of the cycle. Right now they're all together, which is extremely unusual because of the extremity of the collapse. And finally, we would look at the leading, lagging, and coincidental business cycle indicators, because that's just confirmation. Stocks lead because by definition stocks are a discounting mechanism. The business cycle data is often government-sponsored data that has an inherent lag of computation, 6 to 8 weeks and this sort of thing. So we want to look at all those components together when you try to understand where you are. It's very complex. I don't think we need to discuss that one especially. This is more about smoothing of price, using our smoother, which takes out the irregularities, momentum and relative strength, which is not RSI, but just pure relative strength, one item relative to a benchmark. What's left? And finally, there's something to be said about some cyclicality. Sometimes you have intermediate trends rising as long-term trends are rising, and they're convergent and coincidental, and sometimes they're opposite to each other. So you can have an intermediate rise within a long-term bottom, but then it's going counter to the longer-term trend. What you want to do is try to catch them when they're all going together. That's when you make your strongest commitment to a position, whether it's a stock or a sector or a market. I think that's probably our entire thing. We're almost done. Any questions or anything I can answer about interest rates, or any questions about cycles or secular trends? One thing's for sure, the current environment is quite unusual. We found over the centuries that there's, in the United States, which has the largest economy in the world and the largest market representation of the components of that economy, there's usually 12 to 20% of the stock market population which is counter-cyclical to the broad market condition. In other words, when banks are going down, you've got something in the back end like golds that are going up. What we observe now is that it's a completely coordinated decline. Every asset class is under pressure. There is no counter-cyclicality in the market, and we've never seen that in all of our data series going back a century and a half or more.